Hello, everybody, and welcome to another episode of At the Coalface Live. It's great to be here with you today. This is Friday, the 20th of May, 2022, and we've got lot to talk about today. But I want to just couch kind of everything through this e-commerce slash omnichannel lens because this is the space that I absolutely know the best. This is the one that I'm most intimate with. So whilst I watch kind of everything to do with business and markets and investing and crypto and Web3, etc., certainly I guess if I'm staying in my lane or the staying in my lane most tightly, it certainly is ecom, omnichannel, and the like that I can really probably drive the most insights and value out of. Now, what we want to talk about today is really what is the business climate looking like? Now, obviously, this is still very regional, right? And so we have an emerging or likely emerging recession that is likely to hit the global economy. And if we're probably actually already in a recession, even if we haven't had those few consecutive quarters of GDP contraction, et cetera, that typically signal a formal recession being announced by our local governments, by our local central banks, etc. However, I believe we're probably already in a recession, and we can see that through many lenses, and we can see indicators of recession popping up. You know, when you start coming out of recession, we say we can see green shoots, and we can see green shoots in terms of revenue growth of businesses. We can see green shoots in terms of stock market valuations going up. We can see green shoots with inflation being contained and interest rates being bearable for businesses and for consumers. And we see kind of the opposite when we're starting to see things turn down, and when we see things turning more bearish, and we when it appears that we're turning more towards a recessionary environment, we see the opposite of green shoots. We see maybe what we could call brown shoots instead. And so we see skyrocketing inflation, we see rising interest rates, which is really hurting consumers and businesses alike. We start to see businesses going out of business. We start to see funding becoming hard to get. We start to see M&A activity, mergers and acquisition activity. We start to see investing down rounds or funding down rounds, debt down rounds. We start to see public companies taken private by private buyers and taken off the market at low valuations. We start to see cuts in valuations of businesses, particularly public companies around the world. And what we also see is we see that pre-seed and seed early venture investing is probably less affected. So the ability for very, very early startups or even pre-product market fit startups to get funding, that's one of the last things to be affected, because early venture and pre-seed and seed investing are fraught with ultra high risk anyway. So whether you're in boom time or whether you're in recession, it almost doesn't matter, because those really early investments, most VC investors, most friends and family rounds, even some early bootstrapped businesses, they're fraught with risk. And 1 in 10, 1 in 20, 1 in 30 might survive. 1 in 100 might turn out to be a very solid business, and 1 in 1,000 or 2,000 or 3,000 might turn out to be a unicorn. And so those really early investments aren't as affected as latter round investments. So if we look at Series B, C, D, E, and then even IPO rounds, those are the most heavily affected. And we see decreasing numbers of IPOs happening in a down market because valuations are slashed, and businesses don't typically want to go IPO when their value is at its lowest. They want to go into IPO when their valuations are at their highest. So these are some of the what I would call green shoots versus brown shoots that we would typically see in up markets and down markets. And we're starting to see a whole lot of those signals or those brown shoots emerging in almost every country in the world right now. Almost every country in the world is trying to fight inflation. At the same time, they've got weak economies coming out of COVID. And so central banks around the world are between a rock and a hard place. They're trying to raise interest rates to curb inflation, but at the same time, they're taking the wind out of the sails of their local economy. So it's a razor thin fine line. They should have raised interest rates long time ago. They kept the punch bowl out for too long, and now we're dealing with sky high inflation. We're dealing with governments around the world who have poured billions into COVID, into their economies during COVID, printed money like it was going out of style, and all those chickens are coming home to roost now. So we are seeing a lot of these indicators that we are going into a recession. And what I want to talk about today specifically is some of those things that we would expect to see more of in a recessionary environment, and some examples of those things happening right now across the world, across the globe, but particularly through that e-commerce and omnichannel lens. So if you remember what I said, one of the things I said we would oftentimes see during these down periods is we see a speeding up of mergers and acquisitions activity, and oftentimes this can be because we might have a very strong business who can buy another strong business that has been, had maybe taken an outsized hit as economies start to slow down. And not every sector, not every vertical, and not every business will slow down at the same rate, even in a recessionary environment. Some businesses are more insulated against inflation than others. And when we think about rising interest rates, there are some industries that are more affected by rising interest rates than others. We think about property, for example. We think about home buyers, and we think about how massively affected home buying is in a rising interest rate environment. It pretty much instantly pops the balloon of massive property valuation growth. And so what we're starting to see now is we're starting to see some of those M&A events starting to happen in ecom. And we received the announcement today or earlier today, that Woolworths Group in Australia is going to acquire a majority stake of 80.2% in online marketplace Mydeal. And this was announced all across the digital press in ANZ, but this particular article came out of insideretail.com.au. And it reads, Hassan Severtine, CEO and founder of Mydeal, and other key management will retain the balance of the shares and will continue to lead the business after the sale. The deal, and all cash consideration of $1.05 per share, values Mydeal at $271.8 million and is subject to customary conditions, including ACCC and court approval. Confirmation is expected during the third quarter. Mydeal will be delisted from the stock market in Australia. The All Ordinaries ASX will be delisted after the sale is complete. Mydeal CEO Sean Severnay, I think is how you say it. It looks French to me, so I'm probably butchering this. But in any case, said the transaction is a highly attractive proposition to shareholders and represents a significant premium to Mydeal's share price, which of course Mydeal and many other digital first, e-commerce first, type businesses in Australia have absolutely been pummeled over the last 12 months. Their share prices have pretty much all taken the hammering, and some of the e-commerce indices, the e-commerce index on the ASX in Australia has taken an absolute pummeling, particularly over the last 6 months. So I'm sure this is it's a liquidity event, and it's an exit event for the founders of Mydeal, and it's probably a very, very attractive valuation on a historical basis for Woolworths Group. So it's probably a bit of a win for everybody. And he went on to say that the entire Mydeal team is looking forward to partnering with Woolworths Group, which will deliver a step change in the growth of our retail platform by accessing sector-leading capabilities across e-com, supply chain, retail, loyalty, and more. They've committed to Severnay has committed to selling his 47.3% stake in Mydeal shares, and other shareholders, Silver Globe and Avasan Gandal Invest, which together hold or control 28.6% of the target, have committed to vote in favor of the sale, effectively confirming it unless a higher offer is made by a third party. Woolworths Group CEO Brad Banducci said adding Mydeal to Woolworths Group would mark a step further towards delivering a more holistic customer experience in food and everyday needs, and materially expands the company's marketplace capabilities, especially in general merchandise. So Woolworths is obviously looking to de-risk their business and de-risk their reliance on grocery. And Mydeal, this is a fantastic probably liquidity and exit opportunity for the founders and the major shareholders and investors in the business, whilst also being able to fall underneath the very large umbrella, which is the Woolworths Group, multi-billion-dollar business group. And so therefore it probably has some great synergies to it. So this is just one example of what I think we're going to see more and more of, particularly in the marketplace space in Australia. I've long said that I think there are far too many marketplaces in Australia. I don't think it's sustainable. I don't think that the explosion in marketplaces is sustainable in any way, shape, or form in Australia. And I think we're going to see some continuing mergers, acquisitions, rationalization happening in the marketplace space in Australia over the next 12, 24, 36 months. I just don't think we're going to see the amount of launches of marketplaces in Australia that we've seen, say, over the last 2, 3, 4 years. And I think there's going to be some consolidation in the space happening over the next couple of years as well, because there's just too many marketplaces. There's probably too much catalog overlap between many of those marketplaces. And when we have players like eBay, which are very well entrenched, and when we have newer players like Amazon with infinitely deep pockets, it's going to be very, very difficult for the smaller, weaker marketplaces to continue to compete against the much, much bigger marketplaces with kind of unlimited capacity and capability in the market in Australia. Now, if we move on, another acquisition has just happened and just been announced. Was actually announced earlier this month, and that is that General Pants has been acquired by Alchemy Group. In this particular article, it was again all over the Australian press, but this particular article comes from Power Retail. And it says General Pants has been acquired by a retail investment group, Alchemy Group. The purchase will drive growth in the business for both General Pants and Alchemy Group. Alchemy Group currently houses retail brands including Surf Stitch, Pumpkin Patch, Ginger and Smart, and Lego certified stores. And as part of the acquisition, the current owners of General Pants, including Victor Smorgon Group, Phil Staub, and Jackie Vidor, will reinvest a significant portion of their proceeds into Alchemy Group. Furthermore, Sasha Lang, current CEO of General Pants, has been appointed as Group CEO for Alchemy Group. Lang has formerly worked in senior retail roles at Colette, Country Road Group, and David Jones. Alchemy Group has a strong, well-diversified portfolio of retail brands and strong forward growth ambitions. It's a privilege to join the business at this pivotal time, and I look forward to working closely with Richard, said Lang of the new appointment. Of the acquisition, Richard Faccioni, founder and CEO of Acta Capital and executive chairman of Alchemy Group, shared his excitement about the acquisition. This acquisition brings Alchemy significant scale and breadth of operations as we seek to partner with exceptional, like-minded management teams to build great businesses, he said. So clearly this is another situation where we've got a very well-known brand in Australia, fashion brand in Australia, General Pants, acquired by effectively a holding company of other fashion and retail brands. Surf Stitch, Pumpkin Patch, Lego's obviously not fashion, but they're a holding group of successful retail brands with, in many cases, a very strong online play as well as General Pants does. General Pants does have a very strong online play and omni-channel capability. So this is another one of those instances where we see, like-minded businesses coming together, probably seeing an opportunity, at least within Alchemy, probably seeing an opportunity to, I guess, increase not only scale, but potentially consolidate platforms that all of these retailers are running. So we're talking about consolidating potentially back office systems like ERPs, consolidating things like CRMs, consolidating things like e-commerce front-end platforms, personalization platforms, being able to bring loyalty across groups of businesses. So there's lots of potential synergies here. And I think we're going to see these large holding companies. There's a number of other large holding companies similar to Alchemy Group operating in Australia right now. And I think what we're going to see is we're going to see them leveraging each of these individual brands' strengths, both as individual businesses, but also collectively, to see, hey, how can we cross-sell? How can we upsell? How can we bring more value to the customer experience, regardless of which of our brands they are transacting with at any given point in time? And I think what they're going to do is they're going to probably try to take a leaf out of Amazon's book with Prime. And we know that Shopify is trying to bring more value to its merchants and its collective group of merchants, whether that ultimately culminates in a Prime-like loyalty program, whether that ultimately culminates in a marketplace, a Shopify marketplace of brands. We don't know yet. We don't know exactly what that looks like, but they're likely to start to leverage the network effect of Shopify marketplaces. And I see these holding companies wanting to do the same thing, particularly as a downturn comes. They're going to want to consolidate and rationalize any technology running in the business. They're going to want to rationalize the number of teams and people in those teams across businesses where it makes sense to do so. And they're going to want to obviously leverage customer data across all of their properties for remarketing and so many other things that they can do with that data. So congratulations for the acquisition for General Pants, and congratulations to Alchemy Group. But this is just another example of accelerating M&A activity, and I expect to continue to see this to grow. Now, the next thing that I mentioned previously when I first started talking about this was down rounds. And when we start thinking about down rounds, so what is a down round? Well, when an economy is growing, when a market is growing, when a vertical is growing, when a business is growing, what happens is investments that pour into that business, whether that be seed, pre-seed, friends and family, in post seed. So we're talking funding rounds A, B, C, D, E, F, G, whatever you want to go to before IPO, and then at IPO, what you typically see is in strong economies and markets, you see the valuation or the overall net value of that business increase with each funding round, and so therefore the money that typically has to be invested at those different points either goes up at each investment point, or the equity that someone is buying for that same amount of money. So if someone was going to put $10 million investment into a business in an A round, well, then that might buy X percentage of the business. Well, that same amount, that same 10 million in a B round is going to buy typically a much smaller percentage of the business as the valuation of the business goes up with time. So that's reflected, or the valuation in the business it's predicated on a number of things. And there's no exact science to valuing businesses, but it's often times based on a multiple of revenues. It can be based on a multiple of profits. It can be based on growth rates. It can be based on forward-looking expectations of growth, whether it be new products, new markets, etc. So there's a whole art and science to valuing businesses, but generally speaking, as a business grows, as it matures, as it ages, and it goes back to market for more and more funding, typically those valuations are going up. And so therefore, the money that someone puts in, an investment group would put in to secure the same amount of equity in the business and position at the cap table, they would have to put more and more money into doing that. Now, the opposite is true in a contracting market. So if the business is contracting, if the vertical is contracting, if that specific business is not doing well, if it's not as healthy as maybe it was 6 months ago, or if we're having sector changes, if we're having country-specific changes, or we're having global economic changes, so if we're having really secular changes and structural changes to economies around the world, then that can affect the valuation of businesses in a negative way. And so then what that causes is a down round. And a down round is basically where you are going back to market and you are trying to secure investment in your business at a lower valuation than the last investment round. Now, businesses try to avoid this at all costs because obviously for the same amount of money, an investor is taking a larger stake in the business. Or in other words, they have to give away more equity to secure the same amount of investment, which means more dilution for the existing shareholders, which particularly for owners and founders, they don't want to have their holdings diluted. They want to have them diluted as minimally as possible. And so that's why they tend to want to go out and secure investment in an up round as opposed to a down round scenario. But what we are starting to see now is more and more businesses trying to go out and secure finance, either in novel funding mechanisms, whether that be through debt, whether that be through bond issuance. There's a number of ways to do this other than giving away equity in your business, but probably the most common way is to go out and get venture capital is through equity and selling equity in the business. Now, one of the biggest fintechs in the world right now has just announced they're going back to market for funding in a down round scenario. So this article came out in the Wall Street Journal, but again, it was all across the digital press. You can find it everywhere. And the title of the article is SoftBank-backed fintech giant Klarna looks for new funds at a lower valuation. Buy now, pay later startup valued last year at $46 billion could see its valuation fall by 1/3 in a tough environment for tech companies. Goes on to say Klarna Bank AB is seeking to raise new funds that could value the fintech giant at almost a third less than the roughly $46 billion valuation it achieved just under a year ago, according to people familiar with the matter, an example of the struggles facing the tech investing world. Klarna specializes, of course, in buy now, pay later services, a popular type of cash advance that competes with credit cards. Klarna became Europe's most valuable financial technology startup in June when SoftBank Group's Vision Fund 2 led an investment in the company that valued it at $45.6 billion. The Sweden-based payments company is aiming to raise up to $1 billion from the new and existing investors in a deal that could value it in the low $30 billion range after the money is injected, the people said. That would represent a roughly 30% drop from the previous round. Earlier this year, Klarna spoke with investors about a valuation of more than $50 billion, but some balked amid the market jitters, one of the people said. Goldman Sachs Group is pitching investors on the round, said the people familiar with the potential deal. The deal's timing and roster of investors couldn't be learned. There is also always a risk that a deal does not happen. In 2019, Klarna, whose investors included Sequoia Capital, Silver Lake, and Dragoneer Investment Group LLC, was valued at close to $3.5 billion. Its valuation jumped massively through several fundraising rounds during the pandemic as consumers and businesses moved transactions online, a trend accelerated by pandemic-induced lockdowns. Klarna raised money in March of 2021 and was then valued at $31 billion. The June fundraising made Klarna more valuable than most large European banks. Public and private market investors are now second-guessing the inroads Klarna and other buy now, pay later firms made with customers. The share price of NASDAQ-listed Affirm Holdings, Inc., a Klarna competitor, is down 75% this year, giving it a market valuation of $7.2 billion. That decline comes even as the payment network earlier this month boosted its 2022 revenue guidance to $1.33 billion to $1.34 billion from earlier guidance of $1.29 billion to $1.3 billion. So I won't go on to read the whole article there, but you can go and just look it up on the Wall Street Journal or just Google this story and you'll be able to find it. But I think what we're seeing here is a broader implosion, or at least massive questions being raised about fintech in general, but specifically about fintech that is targeted at e-com and omnichannel. So virtually none of these buy now, pay later firms all around the world, operating in any market are making any money. In fact, many of them are continuing to make incredible losses as well. And so that's the reason why they're going back to the market, is because they need the capital injection just to keep operating, to try to attain escape velocity, to try to attain market share, with the hope and the vision, and what they're selling to the market is an opportunity at some place to turn it around and all of a sudden have concentrated market share and be able to be profitable and then create massive shareholder returns based on almost a monopolistic position in the market. But what we're seeing is exactly the opposite. We're seeing these businesses continuing to shed customers. We're continuing to see defaults amongst their customers that they retain. We're continuing to see hemorrhaging. We're continuing to see the fact that as interest rates rise, their cost of borrowing to be able to effectively lend to their customers on a buy now, pay later basis, their borrowing costs are going through the roof. And so therefore their margins, as slim as they already were, are even more tightly squeezed in a higher interest rate environment. And the default count is going through the roof as consumers continue to be squeezed by higher interest rates and a contracting economy. So things are not looking good for the wider buy now, pay later sector. We've even seen some of the buy now, pay laters that have been acquired by much larger halo brands or halo financial services firms take a massive haircut in their valuation. We can think of Afterpay and the cut that Square gave to it. I think it was about an $18 billion cut in valuation, not long after they actually acquired them. And so we're seeing some pains in the wider fintech space. We're seeing pains in crypto. We're seeing pains in the one-click checkout space with the implosion of Fast and the pain that competitors to Fast like Bolt and other one-click checkout systems, they are already starting to see the pain. So basically there's, I guess we could call it a broader dark cloud over the entire fintech sector. And I expect there to be massive consolidation in this space over the next 1, 2, 3, 4, 5 years. And I just think that some of these business models are going to prove to be completely unworkable in an up market or a down market. And that means that those businesses are going to go out of business and investors are going to lose a lot of money in the process. So again, none of what I'm telling you is investment advice, but I guess what we can do is we can learn by the changes happening in these industries and what's happening in these individual businesses, how they're approaching their investments, how they're approaching, going out and securing capital to keep their businesses afloat, how they're deploying that capital with the expectation of future returns. And we can also sort of take some little notes out of their playbook. We can say, okay, are we better off partnering with other brands? Are we better off as businesses, as retailers, as a B2B business, a B2C business, a D2C business, doesn't really matter. Are we better off partnering? Are we better off merging? Are we better off acquiring another business or being acquired? Are we better off pooling our resources and cutting our costs and rationalizing and becoming more efficient as a business? So I think we can take leaves out of all of these books, and we can certainly learn from these, and we can tweak and adapt and apply those things to our own businesses. So hopefully you found this helpful. It's a very, very interesting time to be alive. And as someone who was in business, doing business, during the GFC, and remembers very, very clearly the dot-com boom and bust, it is very interesting to see some of those brown shoots and signals coming from the market, those red flags coming from the market, that we're going to some pretty tough time. And, these tough times tend to last anywhere from 6 to 18 to 24 months. And then the market resets, a lot of debt gets flushed down the drain, and then we can, sort of hopefully reignite our economies and get back on with life. So I wish you all the best of luck. And it's really been a great time being with you today. I love sharing my thoughts with you every single Friday on At the Coalface Live. And I'll see you. I will not see you next Friday. I've got I've got my mother flying over here from Australia. So I'll be spending time with my mom. So hopefully you guys have a fantastic weekend and a fantastic week next week. Cheers, guys. Talk to you soon.